In this example, we're analyzing the pair AME versus HRI and the short entry marked with the red arrow on the chart. Let's walk through the decision process step by step. First, we look at correlation. Historically, AME and HRI have shown mid-strong correlation, meaning they tend to move together under normal market conditions. This is critical. Without stable correlation, there is no statistical foundation for mean reversion. In this example, the correlation is not perfect, but it is high at the time of the opportunity. Next, we examine the half-life. Half-life measures how quickly past deviations between the two stocks return to the mean. In this pair, the half-life is relatively short, which tells us that historically, when the spread expanded, it corrected within a reasonable time frame. That increases our confidence that the deviation is likely temporary rather than structural. We also consider the business relationship between the two companies. AME operates in industrial technology and instrumentation, while HRI operates in equipment rental and industrial services. Both are tied to industrial activity and economic cycles. While not identical businesses, they are exposed to similar macro forces, which supports their statistical linkage. Before entering the trade, it's essential to check for unusual news. In this case, there were no major company-specific events, earnings surprises, or structural announcements that could explain the sharp divergence. This is important. If the move had been caused by a major earnings report, acquisition, or regulatory issue, the deviation might not revert. But here, the movement appears technical and sentiment-driven rather than fundamentally driven. That increases the probability that the spread expansion is statistical. Both half-life and news, together with others, are metrics I check deeply, using my night auto calculation software developed specifically for the use of pair trading. Moving on. The ratio pushed significantly above the upper Bollinger Band, reaching a deviation of over 13%. That is a meaningful statistical stretch, not minor noise. We also see that the move happened relatively quickly, which often leads to overextension. The candlestick structure near the entry shows signs of exhaustion after the spike, which supports the idea that buying pressure may be weakening. Now let's talk about ADX. ADX measures trend strength, not direction, but strength. In this case, ADX was not showing extreme trend strength in the spread itself. This is critical. If ADX were very high, it would indicate that the spread is trending strongly, and strong trends can overpower statistical mean reversion. A moderate or low ADX suggests that the move may be overstretched rather than structurally trending. This supports the short entry. So why was this a reasonable trade? Strong correlation. Reasonable half-life indicating past mean reversion speed. No abnormal news distorting the move. Same macro-sensitive sector exposure, large deviation beyond Bollinger Band. No extreme ADX trend strength. All these factors align. This doesn't guarantee success. Nothing in trading does. But when pair quality, statistical deviation, sector logic, and momentum conditions align, the probability of mean reversion increases. The final outcome of this trade was very successful, generating a 6.16% return in just 4 trading days. This is far from being a standard result in terms of profit size. In my overall trade distribution, approximately 30% of trades end in a loss. Around 60% generate small profits, and no more than 10% produce significant gains. This trade falls into that smaller category of higher performing setups, the type that meaningfully contributes to overall portfolio growth.